Silver just dropped 16% in a single 24-hour window. That is not a normal market move. That is a seismic event. And if you hold silver, or you have been thinking about buying it, you need to understand exactly what just happened, why it happened, and most importantly, what comes next. Because the answer to that last question might be the most important thing you hear about precious metals this entire year. Do not go anywhere. Before anyone panics, and I know some of you already are, let me give you some immediate context. Single-day double-digit drops in silver are rare, but they are not unprecedented. In March 2020, silver fell over 20% in days before one of the most explosive recoveries in precious metals history. In 2011, silver dropped nearly 30% in a matter of days during a coordinated margin requirement increase. Understanding the pattern of what causes these drops and what historically follows them completely changes how you should be thinking right now. So let's break this down properly. What caused this specific drop? What the data is telling us? And what smart money does in the next 30 to 60 days? So what actually caused a 16% drop in 24 hours? There are three forces that converge to create moves this violent in silver specifically. First, macro dollar strength. When the US dollar index spikes sharply, silver gets hit hard because it is priced in dollars globally. A strong dollar makes silver more expensive for international buyers, and demand pulls back fast. Second, margin calls in the broader commodities market. When traders face losses in other positions, they liquidate silver, one of the most liquid hard assets available, to raise cash quickly. This is forced selling with zero relationship to silver's actual fundamental value. And third, the paper futures market leverage effect. Because silver futures are leveraged instruments, a price move of even 2 to 3% can trigger cascading liquidations that amplify the move to 10, 12, 16% within hours. The physical silver market did not cause this. Paper market mechanics did. Here's the most important thing I can tell you right now, and I want you to really hear this. When the paper silver price dropped 16%, physical silver premiums at major US dealers went up, not down, up. APMEX, JM Bullion, SD Bullion. Reports came in almost immediately of premiums spiking as physical buyers rushed to take advantage of the paper price dip. That divergence between paper price and physical premium is one of the most telling signals in precious metals markets. It tells you that real-world buyers who want to hold actual metal in their hands do not believe the paper price reflects reality. When paper price falls and physical premiums rise simultaneously, that is the market telling you in real time that the drop is a technical event, not a fundamental one. Let me show you the historical pattern, because this is where it gets genuinely interesting. In March 2020, silver crashed from $18 to $11, a 38% drop driven almost entirely by pandemic-related margin calls and dollar strength. Within 5 months, silver hit $29, a 160% recovery from the lows. In May 2011, a coordinated series of margin requirement hikes sent silver from $49 down to $32 in days. The metal recovered and continued to attract investment demand throughout that cycle. In both cases, the drops that felt most catastrophic in the moment turned out to be the entries that long-term holders would look back on as obvious opportunities. The pattern is consistent. Paper-driven crashes in fundamentally sound assets create the best physical accumulation windows of the entire market cycle. So here is the forward-looking question. What does a rational, informed precious metals investor do in the 30 to 60 days following a drop like this? 3 moves worth considering. Move 1. Do not panic sell physical silver into a paper-driven price event. Selling real metal at a paper-manipulated low locks in a loss that the fundamentals do not justify. Move 2. If you have been waiting for a better entry into physical silver, this is historically the type of event that creates them. Dollar cost average into physical positions at current depressed prices rather than waiting for the narrative to turn positive. By then, the discount is gone. Move 3. Watch the dollar index. The same macro force that triggered this drop, dollar strength, is also the signal to watch for the recovery. When dollar strength fades, silver tends to recover quickly and sharply. The setup for that reversal is already building in the macro data. Let's lock this in before you go. 1. The 16% drop was caused by macro dollar strength, cross-commodity margin calls, and paper futures leverage amplification. It was a technical event, not a fundamental collapse. 2. Physical silver premiums rose during the paper price drop, which is one of the clearest signals available that real-world demand did not confirm the paper move. 3. Historically, silver drops of this magnitude driven by paper mechanics rather than fundamental deterioration have preceded some of the strongest recoveries in the entire precious metals cycle. 4. The strategic response is to hold existing physical positions, consider accumulating at depressed levels, and monitor dollar index weakness as the primary catalyst for recovery. The drop was real. The panic is optional. The opportunity is yours to decide what to do with. Here is the question I want you to answer honestly in the comments right now. When you saw silver drop 16% in 24 hours, what was your first instinct? Did you panic? Did you see opportunity? Did you buy more? Did you freeze and do nothing? Be honest, because I promise you there are people watching this right now who need to see that they are not alone in whatever they felt. Drop your reaction and your current strategy below, and tell me whether you think this drop represents the best physical silver buying opportunity of the year, or whether you think there is more downside coming first. Both perspectives are worth hearing. If this breakdown gave you more clarity than panic, hit the like button and subscribe for continuous silver market analysis, precious metals strategy, and the kind of financial intelligence that helps you make decisions based on data instead of fear. The metal is still sitting there. The fundamentals have not changed. What changes is whether you understand what just happened well enough to act on it.